Okay, I'm going to get started. So, great. So I want to tell you a little bit about d.light. The focus for my time here, I want to spend really on some learnings that we've had along the way that I think can be applicable to this group. Do you guys know what d.light does? Actually, raise your hand if you know what we do. Okay, not bad. So, basically d.light provides solar solutions for people without access to electricity. And Michael was just saying I should have had slides because it would have been nice to show at least a picture of the product. So I apologize for not having a slide showing our product. But we have everything ranging from solar-powered lanterns, which eliminate kerosene lamps for the household, up through solar home systems, and then solar appliances like TVs, radios, fans. So that's what we do. So let me share actually some, grab my notes here. Share some statistics about d.light that I think are pretty cool, and then I'll get into the learnings. So our company started 12 years ago. So we've been around for a while. And we are going to be celebrating a pretty amazing milestone in a couple of months of reaching our 100 millionth customer around the world. So 100 million people. Yeah, thank you. Yeah, that means every 2 seconds, someone is getting access to d.light solar. Every 2 seconds, which is just amazing to me. We have over 1,500 employees. We have, this is a cool statistic. In 2019, we'll process 35 million payment transactions in Africa. That's 1% of all the mobile money transactions in Africa will be customers paying for a d.light product. In Kenya, about 40% of every Offgrid household is using a d.light product. It could be a solar lantern, could be the whole solar home system. But you go into these rural communities, and these d.lights are everywhere. How many of you have actually gone out into rural Kenya before? How many of you have seen a d.light? Several of you.
I couldn't check whether it was a d.light.
Okay. Or a knockoff, or there are knockoffs, which I think is actually kind of cool, both cool and not cool. But it does show something. In terms of financials, we did about 100 million in revenue last year and are growing at around 40-50% a year. So pretty amazing growth rate with sustainable profitability. And really, one of the things that will be interesting to this group is our financial base and capital base has really evolved significantly. So we started with impact investors and debt funders who had an impact focus to them. And over time, actually in the recent history, last year and this year, we had private equity come on board. And we had, actually just last week, we announced Shell made a major investment in d.light. Actually, it was a secondary investment, so allowed a lot of our early investors to get a good ROI and return on their investment. So we were talking about, are there actually exits? And are there chances for these impact investors to get an ROI? This is we're hoping can be a real case study for, yes, it is possible and it's happening. And it just takes a long time because we've been around for 12 years. So this wasn't an overnight success by any means. And, I think I want to be really transparent also that it has not been an up and to the right kind of journey. This has been a lot of ups and downs along the way, a lot of near-death experiences. And it's one of the reasons why I've so appreciated some of the kinds of investors we've had to get us here. We wouldn't have been able to do it without them. So, with that, I kind of wanted to share a few learnings that I've had that I think will be relevant to this group. So one is scaling up a pay-as-you-go solar business and scaling up, d.light has been incredibly complex operationally. And I think this is true when you're in any sector where you're trying to actually invent the market or create the market and pioneer. It turns out you have to do way more stuff than you realize you have to do. So for us, we started the company because we wanted to eliminate the kerosene lamp. My business partner, Sam, had spent 4 years in Benin. His neighbor's son was burned in a kerosene accident. And we thought, this is an injustice. People should not have to burn kerosene for light anymore. We want to do something about it. And there is technology to make it obsolete. But businesses weren't doing anything about it. We started the company thinking we need to make a great product that can actually hold up quality-wise in these environments and can be affordable price. So we started really as a product company. And we started out at the Stanford Design School, human-centered design thinking, product design. And really, we built a product company. I spent about 4 years in China figuring out how do we do that. And it's not actually easy to build a great product company. And obviously, since then, our product portfolio has expanded. But we have that DNA as a product company. But pretty soon into that journey, we realized that being a product company wasn't sufficient. We can make the best product at the best price, and it will not sell unless we crack distribution. And distribution partners we were working with, they really weren't getting the kinds of volumes we needed them to because solar as a category was kind of unknown. People were uncomfortable with the category compared with other products that were selling faster. It was hard to make the products available in the right areas. So we had to take a very hands-on approach to distribution, much more so than we realized when we started out. And then to make matters even more complex, because building a product company and a distribution company, each of those is really hard. And then, as we got into solar home systems, we realized, at least in Africa, there really weren't large MFIs that we could partner with, and we essentially had to provide the financing to customers to enable it to be affordable. And that's where we pioneered, along with some other companies, this idea of pay-as-you-go financing. This is where customers pay a deposit, and then they pay in increments over time, and then we can remotely lock or unlock the device based on if the customer has paid. So that's how that model works. But that's a totally different business. That requires credit analytics and consumer. Essentially, we're building a consumer finance business on top of a product business and on top of a distribution business. And we didn't really. This was not in our original business plan. We didn't really intend to do all this stuff. We've had ups and downs with each of those kind of business units that we built. And it turned out also that it was very hard to disintermediate those things because these things are all actually interrelated. So as an example, if your product quality isn't that good, or if you're not keeping up on innovation, or you don't have a great after-sales network, which is linked directly with your distribution channel, customers will not pay. So these things are all completely linked together. So this idea of just we can outsource the product, we could outsource distribution, doesn't work, especially in these emerging markets where kind of the quality of partners we could work with or the scale or whatever, it just wasn't there for us to tap into. So basically, these businesses oftentimes are a lot more complex. It can take longer than expected to build up. And I think the operational complexity for investors, I would really encourage you not to underestimate how hard it is to do this stuff. Even like the well-meaning entrepreneurs presenting the business plan just may not realize that, 1 year from then, they're going to have to be building this whole separate part of the business they never even realized they were going to have to get into. So that's one kind of learning I wanted to share. The other is related to it, which is that, building an organization like d.light, getting these kinds of impact numbers doesn't happen overnight. It's taken 12 years for us to get here. And like I said, we kind of had near-death experiences along the way. And this really does require patient capital, particularly in the early stages. And I think now we've just graduated really in the last couple of years to where commercial capital can come in and be comfortable. But we would not exist today were it not for our early investors who had that impact focus, who were willing to kind of ride with those ups and downs along the way. We got some grant funding in the early days too that helped us innovate and experiment. We had lenders, and actually some in this room, New Island Capital. We've worked with Deutsche Bank around the time, like 5 years ago, where we had to really turn around the company. It was a really difficult situation. And we had lenders who actually stood with us and said, okay, we're going to stand with you while you figure this out. And they had the patience to do that instead of just pulling the plug. So that 100 million number would be $10 million or whatever it was at that time, had it not been for their willingness to stand up. And that's not easy for lenders, and not all lenders would have done that. So really kind of that patience in the capital is so important. And like I said, it's not that I think as entrepreneurs in this space, we were certainly very well-meaning, but there was a lot of blind spots we had because we had no idea as we pioneered this new sector and industry, the kinds of challenges we would have to face. So it's a lot of learning curves. And I think what I've seen in the off-grid solar space in the last 4 or 5 years, and this is as the pay-as-you-go model has started to build up, and as capital started to flow in, I've seen investors come in with large deployments of capital into companies with this kind of business model, which on the one hand is exciting, but kind of taking the Silicon Valley model, and I'm from Silicon Valley, so I like Silicon Valley stuff, but coming in with this model of growth, and lots of capital, and get market share. And I think this has really had a big, actually negative effect in our industry because you have companies that are not pushing for sustainable growth. They're growing, but they're not profitable. And when you're just pushing for growth in our kind of sector, what 2 things end up happening, and probably more, but one is negative unit economics. Sometimes you can be scaling with negative unit economics, and that is a recipe for having to raise more and more money at higher and higher valuations, and eventually that all implodes on itself. And secondly, you have low quality credit decisions being taken, so you can hit top line numbers, but eventually that comes back to bite you. But I know, speaking from these other entrepreneurs, they were under tremendous pressure on the top line, and that is not a healthy thing. You want to have growth, but it needs to be sustainable. And I think that's particularly true in working in emerging markets, because this stuff can quickly collapse. And I think there was a bit of a bubble, frankly, in the investment space a few years ago in our sector. And as a result of that, you're seeing some companies going through some painful restructuring. So I would just say patience is needed. This stuff doesn't happen overnight. Even if the market opportunities look big, and they are big, it takes time to innovate and figure this stuff out. And then the third learning I wanted to share, and then I can open for questions, is that at the end of the day, it really is all about the customer. And I think the customer's voice really needs to be more in boardroom conversations, in investor conversations, and I'm not just talking about product, but I'm talking about as business models are developed, and and route to market distribution, as all this stuff is developed, the customer's voice needs to be there. And I think this is a little bit different than other tech companies. So you have tech companies that serve, make cool products, but are essentially designed for people like us. We can also have like a good gut check of if this makes sense. But in our case, the customers we serve, they are not us. They are people who are living in rural communities without electricity. And we can't assume that what we think is going to work is actually going to work for them. And I think that's part of the reason why d.light has been successful. We kind of have come out of the Stanford Design School way of thinking, very human-centered design focus. And I've just seen a lot of examples where the customer is not integrated into the process and it's created problems. And just one example that comes to mind is as this pay-as-you-go model was starting to take off in the early stages, investors were getting excited. There were kind of 2 business models that were being experimented with, I would say. One was a lease-to-own model where the customer would pay and then they would own the product at the end. The other was a service model where they would pay just like a utility but pay indefinitely, and the company would then service the product as it was needed. And I could tell you the service model looks amazing on an Excel spreadsheet. It looks just awesome. The NPVs are great because you just get cash flows for a long time. And there were some companies raising money on that business model, getting like amazing valuations. And to us, the model looks good, but when you talk to customers, it was very obvious, and we did a lot of testing with customers on this, but it was very clear there was a very high desire for owning my own energy. That customers wanted to own their own energy. And yes, you could sell a service model to a customer if there weren't alternatives. You could close that sale. But as soon as the market got competitive, as soon as there were alternatives, customers would just forgo their service contract and switch to lease to own, even if the service rate was lower than the lease to own, because people wanted to own their energy. And it's very clear with customers. So and that's the model we use, and others use that too. And I think it was very painful for companies that started with the service model and then to switch, and your evaluations are set on this, but it's actually not what the customer is asking for. And that's just one example. Frankly, I've seen this play out many other times where things look good on a kind of presentation in a deck or in a spreadsheet, and people are having these conversations in the room just totally out of touch with what actual customers need and want. So I really encourage all of you to be thinking about how to incorporate the customer's voice in the room. And one just very concrete example of this now is something I'm particularly grateful for Assad and for Michael for pushing, is thinking about customer protection in our space. MFIs kind of faced this issue where regulations came, and there's a lot of trauma in the MFI industry, and then it sort of came to an equilibrium. And I think that could happen in the off-grid solar space too, if we don't really think about how do we make sure customer data is protected. We get a lot of data about our customers, so we need to make sure their data is protected. There's not a lot of local laws on this yet, but I'm sure there will be as our industry develops. So let's be proactive on this stuff and do the right thing. About e-waste, about making sure we're not overselling to customers, all these kinds of things. So we're not running into these problems where all of a sudden, while we started out with this mission impact, then we're all of a sudden creating all this negative value for our customers. Let's not fall in that trap. And that's obviously something for companies, but really something for funders to think of. You should ask those questions and be thinking about how do we drive this into the business, because that's a big risk mitigation, I can tell you, for companies in our space. And it's something we're at least trying to take the lead on, and other companies are stepping up, and funders are starting to look at this. But it's an area where, I think really kind of integrating the thought process and the voice of the customer in these conversations and making sure we're really benefiting them and what we do is really critical. So those are the kind of high-level comments. And maybe one other thing I'll say, which is just related to the capital structure change for us over time, which could be relevant to some of you in this room, is as we've now gotten to a place where we're growing really well, we're profitable, our capital base is changing, where we're really not looking for more equity. We have raised some more on-balance sheet debt, but fundamentally where this industry is going is around securitized financing on the receivables that we're booking. And we have enough track record now on the cash flows, predictability on cash flows, that we can start doing that. So that's something that we hope to have some announcements about soon and have a clear structure around it. So funders who are interested in participating in that can actually put their money in, and it's a fairly low-risk way to make a return and a way to participate in the sector that we think is going to be attractive to commercial investors, because we've tried to de-risk as much of this kind of model as we can. And fundamentally, we know to scale this from 100 million to 1 billion, which is what we need to do to solve this problem, it's going to need to unlock capital at an order of magnitude higher. And we think, I'm very optimistic we'll get there. So that's the overall context. I know I didn't talk a lot specifically about all the details of what we do. I'm happy to get into that, but I wanted to at least share some things that I thought would be relevant to you guys who are thinking about things from the funding and capital perspective. So I'll open it up to questions. Yeah.
That on? We good to go? Oh, cool. Hi, I'm Barnett Sherman. I'm with the 10 Bar Group. I have, I think, a question for every 2 seconds. You're creating a new sale on your presentation, but it's great. So when you were going through some of the rough periods, what was it that you said or were able to do to show your initial investors that they should stick with you as opposed to simply pulling the plug?
Yeah, I mean, there was some specific circumstances around kind of how we got into a turnaround. There were some management changes at that time that didn't work out, and I actually stepped back in as a CEO at that time. And basically, the nut of it is that the operating expenses had run up faster than the revenue growth. So we had a very clear plan for how we were going to cut fixed OpEx, how are we going to bring the company to profitability very quickly, and also what steps we were going to do to grow the overall business. And in the light of all that, we really also were clear about, in order to win in this market, we were going to have to win in the pay-as-you-go space, which was kind of an uncomfortable conversation at the board level because it was all about sort of like getting the company to a sustainable level, not burning cash. But I was very clear, me and the management team were very clear, yes, we need to do that, and we need to bet on this because this is where the industry is going. If we don't win here, we are done. So we made some select bets, I would say, as well, to the future, but cut everything that we saw was non-critical. And it was painful. I had to lay off. I mean, when I stepped back into the CEO role, I basically let go of the entire executive team except my co-founder. And we had to make very deep cuts everywhere across the organization. It was tough, but people really rallied within the company. It's one of the things of working for a very mission-focused company. I think people, they didn't want to see d.light, go under. So people stepped up. I remember when I was in China, I had to do these layoffs when I was there. It was very, very hard. And people, I almost like cried when I saw it because there were people they had been let go and they were still at their desks. They're like, no, I just need to finish up this project and hand it over. Just let me do this. I'll be here one more day and then I'll hand this over to you. I mean, they just had that level of commitment. So, it was really, I would say our team is the one who did it at the end of the day, of really pulling through. Everyone just, was clear this was mission critical. We had to do this to survive, and we had to do these cuts to survive. So I think, and it did send a good signal that we let go of pretty much all the senior folks, because it's not like there is accountability here, and people saw that. So we all could kind of rally as a team. And then, like I said, it was the support of the investors. That was all kind of the team and the investors both. Yeah.
You mentioned the voice of your clients, which sounds great like that, but how do you really, to repeat, you mentioned the voice of your clients, and how do you really work it out? How do you institutionalize it? So
it's a good question. So we have, the way we structure our innovation team, we have human-centered design folks that are in region that spend basically their whole time talking with customers, running experiments, and now that we have a call center, we can do A/B testing and things like that for more simple kind of questions. But you get a lot of the value actually from really going deep with smaller sets of customers. I guess you get different kinds of insights from that. So we do both, where we'll do kind of statistically relevant large sample sets with call center, but then go deep with, let's say, 20, 30 representative customers, like for a couple hours each, really understand some key things. And then we kind of make some decisions that way. So that's how we kind of build it into the company. But beyond that, we also, we do a lot to have feedback that's bubbled up from the field, because the field sales team, they're like face-to-face with the customers all the time. So before we make any important decision, we always say, like, talk to the sales team, and we have kind of ways of doing that. But like, hey, what would you think about this? What would you think about this? And we'll get that feedback. One of the challenges with sales teams in doing that is you have to take a little bit of their feedback with a grain of salt, because they can tell you right now what is the feedback they are hearing. But within innovation, I found their accuracy is lower and being able to predict how customers will respond. But it's important to get that data point, and we try to make as holistic a decision as we can with all that data. So, yeah.
I actually have two questions. So the first is, how do you see the sector evolving? Or maybe even for d.light, will you go to 500 million customers? Or will you go to larger units per household? Or will it be maybe something else like microgrids or something? And the other question is about profitability in the sector. I think you are only one of the few that are actually profitable. How will you see the others following you, or will there be is it going to be a bloodbath bath out there? How's it going to evolve?
Yeah. There may be a little more bloodbath, but I think it will consolidate. I think the part of the factor of, I'll answer the second one first and I'll go to the first. So I think part of the challenge of the space being overcapitalized, well, not overcapitalized, but maybe too high valuations, too much money going in too fast, I think has been probably too many companies, at least that are taking this vertically integrated model of doing the product, doing the distribution, and doing the financing. Because it's very difficult to make that model work profitably if you're the number 4 player, or you're the number 5th player. Just the economies of scale make it really, really tough for that to work. Not to mention the time it takes to build those capabilities, which I don't know how you shortcut those things. So I do think there will be some more consolidation. My guess is like this industry probably can't handle like 20 big vertically integrated players, maybe 5 is I don't know what the right number is, but I sense there will be a shrinking of that and some consolidation. And profitability is going to be key. You talk to any investor who wants to deploy significant capital in this space, profitability is the key question they're asking right now. And it's appropriate, frankly. I think it's appropriate question right now to be thinking about. So that's one thing. I think in terms of where we're going, sorry, the question overall is just like where is d.light going overall? Was there something? I feel like there was maybe another nuance to that.
Yeah. So what will be maybe the end game? It will be like a solar panel on each household.
Yeah. Okay. Got it. Yeah. So I think for us, and there's actually going to be a lot of room for many companies to play in different spaces. So I don't think this is necessarily the industry answer, but for d.light, there's only so many things we can do. So we're very focused on building a brand for households, which actually is a very blurry line with small business, but not commercial and industrial, like small business, which are also integrated with homes sometimes and things like that. So we really want to provide an experience for those households and small businesses that would be the same as if they had a grid connection. So you can imagine that will include, to some degree, some higher power solar home systems. There will be some of that, but I think as we're already getting near the higher rungs of the energy access ladder for households at least. And then the key is going to be appliances that can connect into that network. And we already have TVs, we have fans, we have radios, but things like refrigeration. I mean, we're not quite done with that ecosystem of products. Mini grids, I think, are very interesting, but it's such a different business model. From what I understand, probably will require some subsidy and work with the government. We have zero capabilities, frankly, there. It's just not our model. We're a consumer brand, so we're going to build on that. So frankly, moving to TVs is a much simpler thing for us than moving to mini grids. So we will move more into that product space to really kind of kit out the customers' homes. And for customers buying from us, they're not buying solar. They're buying light. They're buying the utility. They're buying the thing. So we've always kind of marketed the end use that the customer has. And then the kind of second, so that will kind of broaden the depth that we have within customers. We'll continue to expand geographically. And then what will be enabling for all this is, frankly, the scalability of the securitized finance solution. Because we can't keep scaling this business with equity and on-balance sheet debt. So equity, you can only do so many times before you get too diluted and risk actually pulling your mission away from where we want to go. And on the on-balance sheet debt, we want to maintain reasonable levels of debt to equity ratios. So, and then it's just a question of if we can get the securitized financing, we can scale faster. And if we can't, we'll have to scale slower. But I see that coming.
So maybe last question on that. Yeah. So who will take the currency risk in the receivables financing?
So it will be priced into the structure. So the way the securitized financing will work, it'll be all local currency in the markets we work in. And it'll be funded through a third party that will essentially aggregate, and then funders can put in. There'll be a defined formula that prices the receivables based on the performance of those receivables, and every month we can sell them off into the structure, and then the currency hedging price is built in. So there's like a US dollar price or euro price, and then the hedging price is added on top. Yeah. Yeah.
You mentioned Aaron Davis from SEMA Funds. You mentioned TVs. How do you talk about impact of TVs and consumer goods, I guess, when you're going into houses with?
Yeah, I wish I could. There's this little video. I'll summarize it from our customer, but I've become a real believer in this. Well, for one, there's a couple different ways I sort of respond to this. One is I have a TV at home, and why shouldn't our customers also be able to have access to news and information, entertainment, all that kind of stuff? So the second, whenever I would go visit customers' homes and I would ask, what do you want next? This is before we had the TV. TV, smartphone. Very clear, and different orders, but it was always, usually TV first, by the way. And then I would say, oh, why? Why do you want it? It's like, I want access to information. I want access to, I want to watch the sports programs with my kids and stuff. And the video that I would have showed you, we asked some people like what the d.light brand means to you. And there was one guy who put it so well. Basically he said, d.light makes rich and poor people the same. Because the rich people, yeah, they may have a bigger TV, but now at home, I see the same thing the rich person sees on TV. I get the same information. So d.light makes us the same. And that was very powerful. And that's, I think, fundamentally at a very high level, I think two giant challenges facing our society today. It's the growing inequality gap in the world, which actually technology is accelerating to some degrees in some places. And climate change. I mean, those are two huge things. And if we can actually bring technology to people that can empower economic activity, that can empower them to be connected into this 21st century, and do that in a way that's totally clean, doesn't have any CO2 emissions, I mean, that's like super powerful to me. So I get actually quite excited about those things, where I think I would have more, angst around would be things like if we sold smartphones with preloaded apps on betting, because I can tell you betting apps are big, but that's where I would start getting into very questionable, impact value. But fundamentally, we want, at least from a technology, information access, connectivity access, we want our customers to enjoy all the stuff we get to have. And I feel like I have a TV at home, my kids get access to this stuff. Why shouldn't our customers?
Two questions.
Yeah.
One, do you foresee after the pay-as-you-go a new change that's going to reshape the market or the players in the market? Second question about the appliances. Do you see that it should be d.light manufacturing, conceiving and manufacturing and selling them, or like an open system, anybody can do apps for the iPhone or the...
Yeah, it's a hybrid, I would say, on the appliances. So for very high volume appliances that work with our system, d.light branded. And the reason why is, I'll tell you about TVs. We work with, we don't design a whole TV from scratch, but we work with contract manufacturers in China. We have we have a very strong team in China, pretty big team there. And we can work with these guys, take the human-centered insights of how do we optimize contrast ratio, how do we optimize all these things, what they want to optimize is wattage. No one else is thinking about this stuff. So we can have a super energy efficient TV that actually holds up in the real conditions, dusty and all this stuff in the rural environments, and is at an affordable price. We can do that through our partnerships with our contract manufacturers. We put in some engineering resources, we can do well. They put in some engineering resources in what they do well. And then we can have a really great off-grid TV that is d.light branded. And then we can upsell to our customers because we know their consumer finance data. So I think for high volume products like that really deliver the value, because like I said, people, they're not buying a battery and panel, they're buying light, they're buying mobile phone charging, they're buying TV, they're buying the use. Now when it comes to things that aren't so high volume, like, I don't know, a DC shaver for barbers, it's a thing, but I don't want to get into that. It's a low, we've always been about how do we get high volume, because that's where we get all the economies of scale and everything works. So our system can work with any DC appliance. The challenge of making it totally open source is that most DC appliances in the market, I can tell you, are crappy on efficiency. So then customers will get our system, get some really horribly inefficient thing and be like, your system doesn't work. So, and we can actually provide the financing for these things. And we have the ability to invest a little more in the efficiency of the appliance because it takes some upfront cost, but it minimizes the overall system costs. Whereas if we made it totally open and said, just encourage the customers to buy TVs from everywhere, we'd have to have a much bigger system in order to power those inefficient TVs. So we see those things as interlinked, but we won't get obsessive about, it's not like an Apple closed garden thing where, we only will work with, or maybe Apple isn't a good example, but we won't be a closed garden approach where we won't work with anything. You can actually plug in any DC appliance, but the ones that we'll finance, we will brand. That's how we think about it. Yeah.
Hi.
Since you have my second, I'm sorry, you did not answer my second question.
Oh, sorry. What was your second question?
What's the change technological? Is there a change you foresee that was, technologically speaking, like the pay-as-you-go totally changed the model? And is there something else you think could happen, or are we stable now?
Pay-as-you-go will extend to appliances as well. The appliances will be able to be locked. And then, I'll get to that one. So that's one. I think that the pay-as-you-go model will likely persist. I think the methods of payment to unlock these pay-go products will widen. It can go to airtime. It can go to linking with banks, and there's lots of other ways you can collect money. We don't want to do cash, but these digital things will expand. But we'll just see how the ecosystem evolves. But I think pay-as-you-go is a pretty good methodology. So I see that for the next 5 years, at least, continuing as being the model for making these kinds of these products work. Of course, there's going to be developments in batteries and other stuff, but that gets a little technical. But I think broadly on the finance side, that's how it'll be. Yeah.
Since you have the distribution channel and the pay-go platform, those have a lot of value that may go beyond the products you're distributing and financing now. Could the business model expand, I don't know, horizontally or what have you, to other products, whether they be related to water or clean fuels or other things that could have high impact into those households? Is that a possibility? Is it a temptation that you want to avoid? Are those not coherent business opportunities alongside your relationship with the customer?
We're open to it because I think we're building good capability to partner with other product companies so we can make sure that they fit a d.light quality standard. There'd be some criteria. We talked about this as a team, like where would we draw the line? For one thing, we don't want to have too many products too fast because that just will confuse the whole sales channel. So we're not in a rush, but they would have to have a sustainability link. So, we're not going to go off and sell, I don't know, making diesel generators or whatever. So we're not just going to sell any old thing or like packets of biscuits. And, there's other random stuff we can get into that's not our core. We'll sell products. We'll sell the sustainable products. And I think absolutely could grow to like solar water pumps. You could think of a lot of stuff that might fit solar water heaters for the roof. But we would do so kind of cautiously, step by step, because one, we would need to make sure we could really stand behind the quality. Two, we need to make sure our after-sales network can service these things, because servicing a solar water pump is actually quite different from servicing. Like, we can leverage a mobile phone repair people to repair our home system. It's actually, the learning curve is not that steep, but when it comes to other things with moving motors and stuff like that, it's a different world. So I think we would just need to make sure we can do it in a way where the customer gets a great experience, because ultimately the reason why we've had also this kind of success and upsell, we have very high net promoter scores. Customers really love and trust the d.light brand. So we have to be very, very careful in moving into new products. But from a strategic perspective, it makes sense, but we'll just do it step by step. And fundamentally, our thought process around it is, what do customers want most? So that's why we constantly are asking customers, so what's next? What do you want next to power? And it got like obnoxious for a while, because every time I'd visit customers, I wouldn't even ask the question. They'd be like, so when's the TV coming? When are you going to bring me the TV? And we're like, soon, it's coming. And so there's some things that just really stand out that are very obvious that we need to provide if we're going to provide energy.
So as a quick follow, are you willing to share what might be the near term, more likely?
Yeah, I can share because it's starting to get into the market now, and this may be a surprise, but we have a d.light branded smartphone that's going to the market that we can then finance to our customers. And I was a little skeptical initially when we started piloting, but it's doing really well. And by the way, the smartphone is preloaded with all kinds of like cool apps that can let them link to their energy usage. Just cool IoT things we can do in their home once they have that product. So I think it does need to link to that ecosystem of their household in some way, but we think that's an important one because almost all of our customers have feature phones, and the economic opportunities that open up when these kinds of customers get smartphones is unbelievable. So, okay, yeah, great, thanks.